Hello and welcome to this Diwali special edition of Smart Money. Here's wishing all our viewers and their families a very, very happy Diwali. Now, this episode is dedicated to you, our viewers, who have loved, supported and encouraged us to keep the show running for over 2 long years. We've received so much love that today we decided to give back by inviting a few of you on our show to get your portfolios assessed by our expert. Joining me for this Diwali special is Mohit Gang of Moneyfront, and we have in fact handpicked a few of you lucky contest winners who will get your portfolio assessed for free over the next half an hour. So let's begin. Mohit, thank you so much for being a part of this special episode, and happy Diwali to you.
Thank you so much, Sonia. Wish you, all your viewers and everyone at home a very, very happy Diwali.
And it has been a great start to this new somewhat, right? I mean, if you look at it, despite all the challenges, India has been so resilient. Portfolios are doing well. We're 5-6% away from all-time highs. Not a bad outcome, you'd say?
Oh, absolutely not. Given what has happened for last 1 year across the globe, right? There's been a massive carnage in US markets. European markets are going through turmoil. But India has been rock solid. And I think the Diwali couldn't have been better for Indian investors. They haven't lost much money. You can argue they haven't gained too much for last 1 year, but overall, I think the portfolios are in great shape and it's looking all very, very rosy and very nice for the years to come by.
Okay, on that optimistic note, we've decided to invite a few of our contest winners, and it's going to be an exciting time. Let's not waste any time, get our first viewer on board, Ronak Raje. He's right here with us in the studio, so let's welcome him. Ronak, please join in. Welcome to our show, Ronak. You are one of the lucky contest winners, and tell us a little bit about yourself. Before we start assessing your portfolio, what do you do and why are you here?
I am a media professional. I've been working for the last 14 years, and I've been building a mutual fund portfolio for almost last 13 to 14 years. And I love to travel. I love to explore new places, and that's my passion. So I really believe in Robert Kiyosaki's principle of that the money should work for you instead of you working for money. And that's the reason I've started building my portfolio.
I understand that your investment goal is to buy a house in the next 7 years and of course plan for your retirement. You're 34 years old. Tell us a little bit about your portfolio and then we'll sort of start the assessment.
Right. So basically, as I said, I started building my portfolio over the last 13-14 years ago. The first goal was actually to mitigate my tax, from the taxation purpose. So that's the reason I have predominantly invested in ELSs, tax savers, etc., which has given me that sort of an edge and helped me sort my ATC. But beyond that, I think I've just tried to ensure that I distribute my funds across 3 to 4 funds, which will help, like they say, that do not put all your eggs in a basket. So that's where I've tried to build like a balanced fund through these 4 funds that you see.
Okay, Mohit, you want to take over? The expert takes over and tells us what's good, what's bad about his portfolio. And the good part is, he told us earlier that he started at a really young age, right? At the age of 18. So the power of compounding is working for him, but you take over.
Sure. I think, Ronak, congratulations, first of all, for starting so early. You're 34 and you started at 20, that means, right? But just to take from where you've given us a brief about your portfolio. Look, Ronak, you've said that I've not put all my eggs in one basket, but once you have a closer look at your portfolio, it actually looks like that all your eggs are in one common basket. Okay. And why do I say so? Because, Sonia, if you go through his portfolio, all the 4 funds which he has are ELS schemes, which are tax saving schemes, right? Now, by default, there are few fallacies to this entire thing. You obviously get to save tax under Section 80C, right? So an ideal allocation in a tax saving plan is limited up to 1.5 lakhs a year, beyond which you actually don't need. Even that allocation should be restricted by the amount of PF which would have been getting deducted from your office salaries, or if you have some insurance component in something. So do ELSs only to an extent that you actually require, beyond which it actually won't serve much purpose in your portfolio, right? Plus it's logged in for 3 years. You should ideally try and incorporate more large cap in the portfolio. So there's not a single large cap fund in his portfolio currently. He can go in for a flexi cap or a multi cap fund in his portfolio. And so ELSs by design will have a combination of all these 3 components, but again, to properly allocate the assets, one needs to have a large cap fund, one needs to have a flexi or a multi-cap fund, and then depending on the risk profile, if you really can take risk, and as I see your time horizon is really long, right? So you want to plan for retirement, and even the house objective is 7 years down the line. So you can also go for a mid cap or a small cap allocation, depending if you can.
If someone doesn't have the time, the bandwidth to sort of invest or do their own research, I know you like index funds.
I do.
So if he wants to invest, is that the route to use sort of passive funds? And if you just can give him a broad outlook on where all he can park his funds.
Totally. I think bang on, Sonia. So to start with, what he can do is he can incorporate a Nifty index fund in your portfolio, right? Okay. So that's fairly simple to be done, and you don't have to then track it.
Right.
Just buy it and forget about it, or keep adding through an SIP mode.
Right.
Buy a Nifty index fund, and you can go for a Pru ICICI Nifty index or a Tata Nifty index or an IDFC Nifty index. They are more or less similar. Just go with the one which has the lowest expense ratio, and I think that should serve your purpose, right? So having that actually gives a good stability in your portfolio. It gives you an exposure of all the good blue chip stocks in the country.
Right.
All the good names in the country today, the top 50 companies will be then a part of your portfolio.
Because it's already curated.
Absolutely. And it keeps rebalancing in an automatic way. Every June, every December, the Nifty rebalances. Dud stocks go out of Nifty, the good ones come into Nifty. So the auto rebalancing keeps happening. It's the lowest cost product, and you technically can't go wrong in it. So as and when you get an opportunity, keep adding into your index fund, and that should, just one single fund should serve the purpose. Once you want to expand your portfolio, that's when you should incorporate either a flexi cap or a multi-cap fund. Okay. You can choose an Aditya Birla Sun Life multi-cap fund, or a Pru ICICI flexi cap fund, or a UTI flexi cap fund. Having that will give you a good dynamic mix of a mid and small cap also in the portfolio. And then as your risk appetite increases, as your overall corpus increases, you can then start having a mid and a small cap fund also in the portfolio.
Okay.
Okay, the last 5 years, if you look at it, the tax saver funds, of course, it helps you save tax, but it doesn't do much, right, Mohit? I mean, the Nippon India Tax Saver Fund has barely given a 5% return, and it's barely double digits for the others as well.
Right.
So how would you read into this?
Look, on the performance front, Sonia, I think the funds are still okay when you compare it with other categories. But as I said at the start of the thing, it's like putting all your eggs in one basket and trying to chase one single strategy in your overall allocation. Right. So, and more or less, these funds will try and be similar in the way they perform also, right? So they'll not give you a standout performance, or they'll not give you a performance when markets are turning against these kind of allocations. So just to say, if let's say 2 years go by where only the blue chip or the top stocks do well in the country, then you will grossly underperform because you don't have a large cap. Or let's say if 2 years go by where only the mid and the small caps work, then again you will underperform because then you have very little of it through these funds, right? So you need to have a healthy mix. You need to have a combination of all the funds, and that's the right way to go with. Just select one tax saver in it, keep adding on to it, or maybe 2 at best, and then remove the other 2.
Well, Ronak, thanks a lot for joining us. All the best with your future investments, and thanks for being a part of Smart Money. Well, our next viewer is joining in all the way from Bihar. We have Deepak Kishan, who is a businessman. He's around 30 years of age, and he's joining us on the show. Deepak, thanks a lot for being with us. Happy Diwali to you, and tell us, why do you want your portfolio assessed?
Yeah, thank you, Sonia. I want my portfolio to be assessed so that, to build a long-term portfolio and fund my own business venture, to build a corpus, basically. So yeah, that's about that's the main objective. And my portfolio comprises of mutual funds and NPS Tier 1 scheme, and not a big amount, only amount of around 1.5 lakhs in equities.
Sure, sure. Okay, we do have your portfolio, Deepak, and I must say that it's way too many funds for someone like you, right? Correct me if I'm wrong, Mohit. These are too many funds for him. He'd rather sort of consolidate his portfolio a bit, but you're the expert.
Oh, absolutely. First of all, Deepak, congratulations for starting and planning your portfolio, right? And basically, look, I think what Sonia is saying that deserves merit, and it has to be considered. Once we see your portfolio, though we don't have the actual values, but there were around 15 odd schemes and SIPs running in 15 odd schemes. If you see some of your allocations, those are very, very minuscule. Even if they double or triple or quadruple from these levels, they won't make an overall impact on your portfolio, right? So I think, let's say, just take an example. There's a scheme in your portfolio where you have an SIP of as low as 150 odd rupees, right? Now, even if that scheme were to burst out in performance, it could be a chart buster. It will just not impact you. And Sonia, I think I need to just make one very important point out here, and that's a very famous saying from Warren Buffett. Where you invest is 1x important. When you invest is 10x important, but how much you invest is 1000x important, right? So it is not always about what you are buying and when you are buying. It's also about how much you are buying. What's the amount of money you're putting to work behind a particular bet, behind your own conviction? That'll determine how much you actually end up making in the long run.
So what's the optimum number of funds one needs to have, right? I mean, is it 5, is it 10? Because he has 15 funds, and I take your point, like, it doesn't merit, you may not grow your wealth at all in such a situation, but 5 funds is good, less than that?
I think 5 to 10 is the best possible combination. And the combination should be such that, Deepak, you have one large cap fund in your portfolio, which could be an index fund. The good part is you already have an index. You've shown good conviction out there. Your selection of schemes is very nice. Let me just tell you. One good part is, so you have your index, you have your multi-cap or a flexi-cap fund. That should be one good allocation. You have a mid-cap, you have a small cap, and you have a balanced fund. That's good enough. It'll give you an exposure across the stock universe. It'll give you an exposure of all different kinds of market capitalizations, different kind of trading styles of fund managers and everything. And then you have debt. The good part is, Sonia, and I think of all the portfolios we've seen, Deepak is the only guy where I see a 20% allocation to debt funds also, which is extremely good and commendable, right? You should have some portion of portfolio into debt funds as well.
But despite, he's really young, so don't you think he should be a bit more aggressive in equities?
I was just about to come on that point. You should always have an emergency corpus or something which you need for short term. That could be, let's say, next 2 to 3 years of your travel expenses or your children's education or something which can come out of debt funds. But then you don't need to have an SIP running in debt funds, which is where I think, Deepak, what you can do, Deepak, is you can move your SIPs from debt fund into equity, because the whole concept of SIP is to reduce volatility, and debt by default is a less volatile asset. What you should do is, whenever you have a lump sum chunk, you put it into debt, and whenever you, for whatever SIPs you're running, you just run it into equities.
Okay, Deepak, thanks a lot for joining us. All the best with your investment journey, and keep watching CNBC TV18. Thanks a lot for being with us on the channel. Let's slip into a quick break on that note, but many more viewers lined up to assess their portfolio, so don't go anywhere. Welcome back to this Diwali special edition of Smart Money, where we've invited a few of our select viewers to get their portfolios assessed live right here on Smart Money. Our next investor joins in. Hemal Mehta is here with us in our studio. He's an avid viewer as well as an investor. Hemal, please join in.
Thank you, Sonia.
So tell us, Hemal, a little bit about yourself, and you're the contest winner, so congratulations.
Thank you.
And tell us about your investment journey.
Myself, Hemal Mehta. I'm working with broking house Ashika Stockbroking, and I started January from 2005 in stock market, and in mutual fund I started from 2019 aggressively.
How old are you? What are your investment goals?
My age is 43 years, and I have 2 goals in my life. One is, after 15 years, at the age of retirement, 58, I want to have some money spent by my wife.
Okay.
And the second goal is to provide education for my 6-year little girl.
Okay, I think all of us have common goals, right? All 3 of us.
Yes.
Retirement and our child's education. Yes, so take it away. Let's see your portfolio. Let's get it first up on board. And then, of course, the expert will take it forward. Mohit, over to you.
All right. Hemal, thank you very much for sharing your portfolio. The funds which you have selected are good. The fund houses are also good. But you've highly concentrated your portfolio, yes, right? So it's only Mirai and it's only Parag Parikh. They're just 2 players in your team, right? And as I said, you can't have 15-20 players. That was for our last guest, but you can't also have just 2 players running your entire team. So you need to just broaden up the entire horizon a little bit. The allocation in Mirai asset focused is fairly high. As I recall from your portfolio, it was like around 35%
yes,
of your overall portfolio, right? So to my mind, I think any particular scheme having more than 15% allocation in a portfolio, I think it's a no-go zone, because at around 10 to 15% allocation, you will have a good, at best, 10 schemes in your portfolio, or you will have around 6-7 schemes in your portfolio, and that's an ideal portfolio to construct, right? So I would just say expand it a little. Try getting a large cap fund in your portfolio. You don't have one, you have a focused, but that in itself is a very concentrated strategy. Now look, in your case, I understand because you come from a trading background. You've started with your journey with stocks and then migrated to mutual funds. Ideally, it's the other way around for most of us, right?
Yes.
So you start with mutual funds and then gradually as you gain confidence, you move into stocks. But you started the other way around. So I understand that you might be comfortable with the risk. But focus fund is a very concentrated category. It'll have only 30 stocks. You get into that category once you're done with your large caps, your multi caps, and if need be, a mid and small cap, right? So I would just suggest go with an index fund, go with a flexi cap fund, try getting a mid small. By default, if you incorporate this, the overall percentage allocation of the other categories will reduce.
But do you want to do an assessment of how his funds are doing at the moment? I mean, compared to, say, a 5-year or 3-year average, how do the funds look?
Absolutely, absolutely. Look, so Parag Parekh Flexi Cap, I'll come to that. It's been a rock star, rock solid fund for many years. Rajiv Thakkar has done a great job, fantastic job. And I think one of the great part about the performance of the fund was it had international exposure much before any other scheme could possibly fathom that international exposure will create that kind of an alpha in a portfolio. So they've always been carrying that 20 to 30% international exposure. Because of few regulations of late, the exposure has come down now, and the performance has also been okayish for last 6 months to a year, but it's a great fund to hold in the portfolio. Tech saver, obviously you need to have one tech saver for your ELSS purpose, so that's fine. Again, you don't need to have 2 tech savers, right? And you can just consolidate between one. Now, Mirai Asset Focused honestly has not been a great performer in that category. If you assess the fund against the peer group and the benchmark also, it's been a little bit of a wobbly performance for that, but as a fund house, they've done great work. Right, Nilesh Surana continues to do great work, though he's not the direct fund manager for the scheme, but as a CIO of the fund house, I think he's had a great track record. Especially the emerging blue chip fund of theirs has been a rock solid fund. But again, my recommendation here will be you hold. Don't continue to increase the allocation in this, and try and incorporate new funds, perhaps an index fund and maybe a multi-cap fund in your portfolio.
All right, Hemal, thanks a lot for joining us and all the best with your investment journey.
Thank you.
Well, our next viewer is joining in all the way from New Delhi. We have Jaganmeet, who's with us on the show. Jaganmeet, thanks a lot for being with us. Happy Diwali to you and welcome to CNBC TV18. Go ahead, tell us a little bit about who you are and what is your investment journey.
Hello, ma'am. To you also, happy Diwali and Mohit sir. I am a second officer sailing on merchant ships since 2009. And I have been investing in mutual fund from 2018-19 onwards. And I look forward to India's prosperous days ahead, and I have a very good conviction in India's growth. So I would like to understand, my present mutual fund portfolio of around 11 lakhs could give me a retirement corpus of about 2.5 crore when I retire.
It's a very, pointed plan that he has in place. He has a portfolio of 11 lakhs. He wants a retirement corpus of 2.5 crores. And here is his portfolio. He's into index funds. He's just 34 years old. So go ahead, Mohit, your view.
I think I like the choice, honestly. You've taken a Nifty 50 and you've taken a next Nifty 50. So you've gotten the top 100 names in the country. Those are a part of your portfolio. You can't get it better. You can't get it all right, right? I think you just need to ladder down a little bit. You just need to come down this ladder in terms of market capitalization. The 2 funds are great. Continue to hold them as long as possible, and you can just sleep over it, right? You being in Merchant Navy, I'm sure you travel a lot. So obviously you want to buy something which you can just forget about it, right? But consider adding a flexi cap fund. And if you can, because your goal is too long, it's a retirement goal, right? And the corpus is fairly huge. I would suggest you need to go down into the mid and small cap categories also, because those are the funds which will give you a little extra return over a longish period of time than what your large cap portfolios will give you, right? So add a multi-cap, add a mid and small cap fund in your portfolio. On multi-cap, you can go with an Aditya Birla Sun Life multi-cap fund, or on the mid-cap side, you can go with a Kotak Emerging fund. Small cap, again, even in the mid-cap segment, you can go with one passive and one active fund, right? And in small cap, you can go with an all active strategy. You can add 1 or 2 small cap funds in your portfolio. You can go with an Axis small cap, or you can go with a DSP small cap, right? But you need to have those in your fund to give it a proper flavor and texture. Because your goal is too long, far away, you can take that additional risk in your portfolio. But otherwise, with the 2 funds you have in your portfolio, hats off. Good choice.
Okay, good choice. Jaganmeet, thank you so much for joining us and wish you a very, very happy Diwali as well. Thanks for being with us on CNBC TV18.
Thank you, man. It's my pleasure.
All right, with that, we wind up another edition of Smart Money. Thank you so much for writing to us, sending us all your portfolios. Because of paucity of time, we couldn't take all of them up on the show, but we'll definitely do another edition of your viewer portfolios getting assessed live on CNBC TV18. Mohit, always a pleasure. Happy Diwali to you, and hopefully we'll celebrate many more Diwalis together here on CNBC TV18 and many more prosperous ones.
Absolutely. I just loved the format today, Sonia. So, and wishing you, all your viewers and everyone at home a very happy Diwali.
Thanks a lot. Thank you so much. And thank you viewers for joining in as well. Have a great weekend.